Okay, here we go. Question 2. Question 2 is Fresco. Question 2. Fresco. June 2012, and the time is 14:21. It's a 25 mark code, 45 minutes. 45 minutes until that is 15:06 finish. Question 2 is prepare a statement of income, prepare a statement of changes in equity, prepare a statement of financial position. Doesn't ask you for the notes, does it? It doesn't ask you for the notes. You know, it never does. It never does ask you for the notes. It doesn't ask you for director's report. Quite right. It's really to check your accounting ability. Then part B, calculate the basic earnings per share for Fresco for the year ended 31st March. Notes are not required. Students traditionally, in my experience, students traditionally hate earnings per share, and it's such a shame because it's 3 gift marks. Alright, so it's a full set of financial statements. Guidance is given as to the mark allocation, but if you have done enough of these from the revision kit, if you have followed enough of these from the recordings that I've made for you on the Open Tuition site, you don't need that mark guidance. You can finish this question within the 45 minutes. But it's up to you. If you want to go into the exam room ill prepared, that's your decision. The preparation is there to help you. Okay, question 2. I'm going to start reading. I'm not reading the numbers, except just quickly. I see a suspense account down at the bottom of the trial balance of 13,500, so probably a share issue. It normally is if there's a suspense account involved. It's probably a share issue because the finance director, I love this, the finance director didn't know what to do with it. And you're looking at a suspense account of $13 million, and they've got a finance accountant, finance director, who doesn't know how to deal with the share issue proceeds. Not proceeds, share issue credit entries. The other thing to be aware of, just while very quick look, 2 things actually. Typically in question 2, Steve Scott will show the bank as an overdraft. More often than not he has it as an overdraft, because when you come into preparing the statement of financial position, naturally you'll think down the current assets, inventory, receivables, prepayments, bank, and Steve Scott often puts the bank as an overdraft. It should therefore be included within liabilities. Halfway down the trial balance, there it is, bank, and it's a liability. Deferred tax, I'm glad deferred tax is there. He always has the tax adjustment, tax calculation to do. And down at the bottom of the trial balance, we've got the current tax as a debit amount. The only other thing which I'm looking for is loan note. Do I see a loan note? Oh, that's a disappointment. He normally has something where we have to time a portion because we've only included, for instance, 6 months, and we should have included 9 months or a full year's worth of loan interest. I don't see it there. We might do, let's have a look at these notes to the question. I'm going to start, as usual, I'm going to start with point number 4. The income tax calculation shows a tax refund of 2.4. The balance on current tax in the trial balance represents under or over from last year. Don't actually need to know, do you? You do not need to know whether it's an under or an over provision, but just let me show you what happened last year. Last year we would carry down a liability, say 3,000. Just say this is the position last year, brought down 3,000, and that's how much we thought we owed the taxman last year. And then when we settled it, when we settled the debt, we credited cash 3,008, so that now we're in the situation of a brought down figure of 800, and that's where we're starting this time. So that 800 is an under provision from last year. We actually had to pay 3.8, but we'd only provided 3,000. It is an under provision. It looks like it's an asset. In fact, it's an expense. But we don't actually need to know, because the way I'm going to show you, the way I always do show you, the way I've shown you on numerous occasions in the past, is that if we have two accounts, one for deferred tax and one for current tax, and there are many exercises at the back of your F7 notes for you to practice this. Per the question, we've got a deferred tax brought down. Per question, brought down. Deferred tax of 3,200. You need to be aware that you pick the right figure up here, and I suggest always to my students that they take a straight edge into the exam room with them. Per question brought down is 800 on the current tax, and then we can get into paragraph 4. The income tax shows a tax refund, so we want to be showing an asset here. We want to be showing an asset of brought down 2.4 million, and it must have come down from above the line 2.4. That shows a tax refund. The balance on the current tax represents under or over provision. We had taxable temporary differences of 12 million requiring a deferred tax liability, and the tax rate is 25%. 12 million at 25% is 3 million. That's the deferred tax provision that we need to have brought down. So it's carried down from up there. We already have 3.2 in the deferred tax account, so our missing figure is 200. Take that to the current tax account, so debit deferred tax, credit the current tax. Balance off this, 2.6, 2.6. Missing figure is 1.8, and that's going to go to the income statement. 2 marks, thank you very much. Just give me the 2 marks. It's routine, it's standard stuff. This is 2 marks that no student can afford simply to throw away, and it's practice, 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 practice. This is standard stuff. That's standard, putting in the figure from the question. This is standard, the temporary taxable differences and the tax rate. So that figure and that figure are standard figures. This therefore is the missing figure, and it's going to go to the current tax account, so that's also standard. This is a little bit tricky because you don't often find that there's the tax calculation showing a tax refund due. Normally it will be that way, but it isn't in this question. It's a tax refund due, it's an asset, it's below the line, below this line, it's on the left hand side, it's a debit, it's an asset. So balance off this account, and that's an income statement credit to the income statement account. It's not an expense, it is a credit to the income statement account. It's going to increase this year's profit after tax. Point number 3, Internal Audit Department. He's done this before as well. We've discovered a fraud committed by the company's credit control. He didn't return from a foreign business trip. 4 million of the company's receivables have been stolen and they're not recoverable. Of this amount, 1 million relates to last year. Ah dear, I can only hope from the auditor's point of view that that million undiscovered fraud was immaterial last year. Whoever were the auditors, looking at the size of the company, it's presumably a big 4 audit firm. I just hope that their paperwork is sufficient. Of this amount, 1 million relates to the year ended last year, and the remainder is current year. We're not insured against this fraud. Okay, so point number 3, we need to restate last year retained earnings brought forward by, what did it say, 1 million last year? 1 million relates to last year by 1 million, and this year we're going to have an exceptional item of 3 million. and reduce receivables by 4 million. Point number 2 is always in. I'm going to leave point number 2. I'm just going to go straight into point number 1. Point number 2 is long. It's not complicated. It's not difficult. It's always there. You have to do the depreciation calculation. There will be bits and pieces. There may be self-constructed assets which were finished only halfway through the year, with pro rata depreciation, and things which have been charged to cost of sales which should be capitalized. There may be finance leases which have so far been treated as operating leases. So point number 2, the non-current asset now is going to be complicated. It always is. There'll be at least two different rates of depreciation to apply. So I'm going to leave that and just go into point number 1. The suspense account represents the corresponding credit for cash received for a fully subscribed rights issue of equity shares. The terms of the share issue were 1 for 5 at a price of 75. And the price of the company's equity shares immediately before the issue was $1.20. That last bit of information, the price of the company's equity shares immediately before was $1.20. That's important for the earnings per share part of the question, part B of the question. We don't need it for any other purpose, we just need it for part B of the question. So what we've done is we've debited cash with $13,005 and we've credited suspense. This is what we have done. $13,005. And this is clearly this is bad. This is bad news. Terms of the share issue were 1 for 5 at a price of 75 cents. Well, if you look, the top line of the trial balance, the equity shares are 50 cents each. Be careful of that. They normally you can assume that the shares are going to be $1 shares, but this time he specifically tells you they're 75-cent shares. So there are 90,000 shares in issue. Another clue about this is that these shares were being issued at a price of 75 cents, and of course in English law, and I'm not able to speak about any other country's law, in English law it is against the law to issue shares for an amount less than their nominal value. So we've got 90,000 shares here, and 1 for 5 is 18,000 new shares which have not been credited to the share capital account. They instead have been credited to the share premium account. So 18,000 new shares at 50 cents each is $9,000. And we've received $13,005, so $4,500 is share premium. Now what I'm going to do is I'm going to go back to my question paper. I'm going to write on my question paper against the 45,000 I'm just going to put plus 9,000, and against share premium I'm putting plus 4,500. So that, don't forget that then. So that's share capital increase and that's share premium increase, and the decrease obviously is debit the suspense account. That deals with point number 1. Now point number 2, we've got this non-current asset notes. Let's have a read. To reflect a marked increase in property prices, we decided to revalue the property on the 1st of April, the first day of the accounting year. The first day of the accounting year. So we need to revalue it with effect from a year ago and then depreciate it for this year based on this new value. So leased property last year was 48,000. That was the cost, and there was amortization of the lease of 16,000. So at the start of the year our lease property had a book value of 32, and this is going to go to 36. And on that date, I'm in note 2 again. We've not yet recorded the revaluation. The remaining life of the leased property is 8 years. Last year, on the 1st of April 2011, it had a life of 8 years, so divide by 8 is 4,500 depreciation, and on the balance sheet we're going to find 31,500. And we also need, do we not? I think we also need a revaluation account. Revaluation reserve is that 4,000. Okay. But look, the line 4, Fresco makes an annual transfer to retain profits to reflect the realization of the revaluation reserve. Okay, so this 4,000, we're going to bring that back into the retained earnings. So this year we're going to take revaluation reserve and reduce it by 500 and increase retained earnings by 500. This annual transfer of the revaluation reserve. Okay. Does not give rise to a deferred tax liability. So I'm in paragraph 2 now of point number 2. Acquired an item of plan. Again, notice it's the first day of the accounting year. Oh my lord, Steve Scott has been gentle with you a lot this time. Acquired an item of plant under a finance lease had an implicit finance cost of 10%. These payments in trial balance represent an initial deposit of 2 and the first annual rental of 6 million paid. And if I look on the trial balance, 6 figures up, debit side, lease payments 8 million. Lease agreement requires further annual payments of 6 million on March each year for the next 4. If it had not been leased, it would have cost 25 million to purchase for cash. So what we've done is we've credited cash 8 million, debited lease payments 8 million, and we have not debited the TNCA, and we should have done. So what we're going to have to do is I'm going to have a finance lease creditor working. And the cash price of this asset, the cash price was 25 million. And that's the amount which is going to be debited to our TNCA account. And that's how much we owe. If we had been able to afford, we could have paid our lessor. We could have paid him 25 million, and that would have been the end of the matter. But we couldn't. So we paid a deposit. We paid an amount of 2 million, which this is the day we signed the lease, so there's no interest element within that 2 million. It's an initial deposit paid on the first day of the period. So we actually are borrowing 23 million, and interest for 2011 at, what did it say, 10% is 2.3. So just before we make our first 6 million payment, we're actually owing 25.3, and then we pay the 6 million. So now we owe 19.3, and that 2 and the 6 are the 8 which is shown in the trial balance. We have credited cash and debited lease payments account. We've credited cash 6 million and debited the lease payments account. But included within that 6 is this 2.3 interest. This is the liability at 31/3/2012. But you know, to pick up the extra marks, we need to subdivide this. Some of this is long-term, some of it is current. And the way I'm going to show you how to do this is if we just work this table through one more year. So interest for 2013 is 1.93, gives me 21.23, and I'm going to pay my second instalment of 6 million, gives me 15.23, and that, at this year, is the long-term liability. And the short-term, the current liability, is that 4.07. That's the current liability. Had the plant not been leased, now we need to think about depreciation, because this figure 25 is going to go to increased TNCA, and we're going to have to depreciate it. The lease payments in the trial balance represent an initial paid and the first annual rental of 6. So we paid this 6 million on the 31st of March 12, and we've got another 4 lots for the next 4 years. So it's a 5-year asset. So 25 divided by 5 is 5 million depreciation per annum. Okay, that's straight line. The next bit, plant and equipment, the third paragraph here. Plant and equipment other than the leased plant is depreciated at 20%, reducing balance. So we've got plant and equipment per the question of 47.5, and it doesn't include any of this leased plant because the entire leased plant has been recorded simply as 8 million lease payments. Per the question is 47.5. Accumulated depreciation brought forward was 33.5. So the reduced balance is 14, and 20%, that's 2.8 this year depreciation. And on the balance sheet it's going to be 11.2. 14, that's 14 minus 2.8. No depreciation amortization has yet been charged to any non-current asset, and it's going to go to the cost of sales. And that's it. That's it. We're in a position now where we can fasten this lot together. No adjustment to the revenue, which is a bit unusual for him. So statement of comprehensive income. Revenue, this is where your straight edge comes in as well, because it's so easy to pick the wrong figures up. 350,000. Cost of sales per the question is 298,700. But then we've got all this depreciation to come through. We've got I need to go back up here. I've got that 4,500 depreciation. And that 5 million, 4, 5 and 5 and 2.8. 4, 5 and 5 and 2.8. Depreciation, amortization. So that's 2, 10, 21, 2, 31, 311. I think so. 39. It's looking good. Looking good. So 39. Then we've got the distribution costs. Per the question it's 16.1. Admin expenses, per the question, it's 26.9. Finance charges, that's the interest here, 2.3 interest. But there's also, as I remember, there's some bank interest. So it's 2.3 plus 300, that's 2.6. And that gives me 30, 42, 44, 45, 600. Oh, look! Now then, this is the stage where you've got to be brave, because I'm showing a loss of 6.6, and we don't like losses, do we? You and I don't like losses in exam questions. However, that's loss before tax, and then the tax, we can go back to our working for the tax, wherever it is, there it is, and it's an income statement credit of 1,800. So that ameliorates, that reduces this loss by 1,800. 4,800 loss is the change figure. And now we've got the exceptional item. I suppose really I should have put this before tax. The exceptional item is 3 million this year, so 7.8 million is the loss this year. I'll call that profit after tax. And now the only other thing is we've got the revaluation. So now we're into the comprehensive income. The revaluation of the property was, what was it? 4,000. Of which the annual transfer of 500 comes off it. So 3,500. 4,300 I think is the loss, isn't it? 7838. No, silly. That 500 is positive. That's going to be reflected within the revaluation account. 453,003. That should be okay. Statement of comprehensive income. Sorry, statement of financial position. No, I can't even do that. I've got to do statement of changes. Statement of changes in equity. Shares, what have I got? Shares, premium, retained earnings, revaluation, total. 2011 as stated was shares of 45,000, stupid, 45,000, premium of 500,000. Retained earnings, we're given the figure for retained earnings, aren't we? Retained earnings at 1st of April as originally stated of 5,100. There was no revaluation, 45.50, so 55,100. And then we have the fraud, and that was 1,000,000 and 1,000,000, so 54,100 for 100. Are we alright so far? And then we've got these new things coming through. We've got the share issue. That was 9,000 and 4,500, 13,005. Okay. Then we had the revaluation. That was 4,000. And the annual transfer. 500 to increase retained earnings, 500 to decrease. Forgotten this year's figure. And finally this year's results. And this is the figure before these final adjustments here, these comprehensive income things. So 7,800 was the loss. Let's see how that gets us. 54,000, 9,500, 4,632, 35, 54, 67, 6, 71, 6, 70,800, 63,800. I don't know if that's right, I have no idea, but we'll take it that it is. Statement of financial position. No ACCA involved, but we did have some leasehold property, and it started off as 32,000, but we increased it by 4, and then we depreciated it by 4.5. So that gives me 31.5. Yeah, and then we have P&E, and I'm going to exclude I'm going to deal with the leased plant separately because it's on a different depreciation rate. Leased plant was 25 minus the 5 depreciation, so that's 20,000. This one was 47.5 minus the depreciation brought forward, which was 33.5. That gave me the 14,000. 20% of that was 2.8, so that's 11.2. I'm just checking, I can't see any, no other assets, so that's 62,700. Inventory, do I have any inventory? Yes, I do. Inventory, be careful, we are given cost of sales here, so the inventory must be the closing inventory. If we had not been given cost of sales, then the inventory in the trial balance would have been the opening inventory, and sometimes he does it. You just have to be very careful, but he will if it's a genuine trial balance where we're not given cost of sales, we're not already adjusted for the closing inventory. The closing inventory figure will be within the notes to the question. Receivables, This was 28.5, but there's 4 of that's gone, been stolen by our credit controller. The bank is an overdraft, but we do have a current tax refund due. Just let me check that current tax refund. What was it? 2.4. I can't see any other assets. 49.51, 52,100. 114,800. That's fingers crossed, I'm afraid. Oh, let's see what we've got up there. 63.8. Okay, 114,800. Shares is 45,000. No, it's not. It's not. It's 45 plus 9. 54,000. The easy way of doing this, of course, is to look at the statement of changes in equity. Premium is 9,005. Retained earnings 3.2 negative. And revaluation was 4,000, we've lost 500 of that, so it's now 3,500. That's 398, 63,008. Now we've got the long-term debt. What have we got? Deferred tax. Deferred tax is way up here. Deferred tax 3,000. What else do we have by way of long-term debt? Oh, we got the finance lease creditor. And we did work that out as well, didn't we? We did work down. There we are. That's the long-term liability, 15.23. Short-term is 407. 15.23. 82,030. Current liabilities, we've got payables 27.3. They've got finance lease creditor, and we got the bank. The bank is 1.4, and the finance lease creditor, I can't remember it, 4.07. 27.31, 32,720 is 114,750. That's 407 now. 31, 32,770. 32,770. 114,800. Does that? Yes. Okay. So that's the income statement, the balance sheet, and the statement of changes done. All we've now got to do is part B. How are we doing for time? 14:54, and I've got until 15:06. I've got 12 minutes. That's okay. Right. Earnings per share is earnings available for equity shareholders divided by the weighted average number of equity shares. And the earnings is easy because you're not likely, let's be honest, you're not likely to have arrived at 7,800 unless you did, which is excellent, very good. But that's what the figures we're looking at, 7,800. It's profit after tax, after non-controlling interest. It used to be after extraordinary items, but there are no extraordinary items these days. So 7,800 is after the exceptional item. It's there. It's after the tax, after the exceptional item. 7,800. The problem we've got is this figure, the weighted average number. We do know how many shares there are in issue, or were in issue at the start of the year. There were 90,000 shares in issue, $45,000, but then there were some new shares issued partway through the year. So we need 5 columns. We need a working, the date, the number, the period, the fraction, and the weighted average number. the date, number, period, fraction, and weighted average number. As a Brit travelling abroad, when Eastern Europe started opening up, I was given the happy opportunity of travelling quite extensively around Eastern Europe, teaching, and of course in an evening when I'm sitting on my own in some hotel bar, reading and preparing for the next day's lectures, it was not unusual for young ladies to approach me and invite me to help the local economy. And I continually reminded myself of these columns in the earnings per share calculation, and I reminded myself and said, it is a rule of my own, do not pay for women. And so you can remember the 5 headings for the weighted average number working exercise. The date is always the first date of the accounting period, which was 1st of April 2011, and we know that there were 90,000 shares in issue, and this changed. It changed on the 1st of January 2012, according to note number 1, when there was another 1 for 5, so there's now 108,000. 1 for 5 means there were 18,000 additional shares. And the period, I always do this on my fingers, but I'll do it on the screen: April, May, June, July, August, September, October, November, December. It's 9 months. But I also do this one as well: January, February, March, because if I've made a mistake here, then simply to say, well, that's 9/12, therefore that is 3/12, and then I also add it up actually, you won't give yourself the chance of finding out that you've miscounted those months up there. Fraction, the rights fraction. The rights fraction is a little calculation of its own. We did have, before the rights issue, as a 1 for 5, we did have 5 shares just immediately before, and each of those shares was worth $1.20, so our investment was worth $6. Now we've bought one more share, it cost us 75 cents. So now we have 6 shares, and they're worth $6.75. Our investment is now $6.75. So theoretically, each of these 6 shares is now worth $6.75 divided by 6. That's 1,125. So that's the cum rights actual price. This is the theoretical X rights price, and the rights fraction is simply 120 divided by 1.125. And the rule is multiply all prior periods, that's the rights fraction, multiply all prior periods this year by the rights fraction. Well, this 9 months is a period prior to the rights issue, and the rights fraction is 1 divided by 1.125. This 3 months is after the rights issue, and so we will not apply the rights fraction. Now I'm going to multiply these 3 columns together to give me the weighted average number. So that's 90,000 times 9 divided by 12 times 12 divided by 1125 gives me 72,000 shares. And this one, 108 times 3 divided by 12 is 27,000 shares. So my weighted average number is 99,000 shares. That's my weighted average. And my earnings per share therefore is 7,800 loss divided by 99,000. So 78 divided by 99 is 78 cents? No, 7.8 cents loss per share. And that's 3 marks. And this is really where the 3 marks is. It's the ability and the way and the knowledge to calculate this 99,000's weighted average number. If you don't get to the end, and you can work this out, why not put here, why not put earnings divided by shares, weighted average number of equity shares, why not do that and put, say, 50,000, and you've calculated the 99. And you don't know whether the 50 is profit or loss. But you're showing you can do that calculation. Because that's where your marks are. That's where your 3 marks are substantially going to be credited. So if you don't get through to the bottom of the income statement, if you never actually reach that, you can still achieve, is that right, 7.8, 78 divided by 100 divided by 99 is, yeah, 787. Alright, 7.9. It's actually 7.8787 loss per share. Okay, but this is where your marks will be. So even if you don't reach the bottom of the income statement, just put a safe figure in, do the calculation, divide one by the other, and Bob's your uncle. Okay, and the time is 15:01. That actually still means I've got 5 minutes left, which I don't need, I'm not going to use, there's nothing I'm going to say or do in the next 5 minutes, but just to show you that even going slowly, because I think I am going slowly, even going slowly and explaining things, this exam is achievable. It can be done, and it can be done within the time available. Okay, now I'm going to go for a coffee and then I'll come back and have a look at question 3 with you.